Good afternoon, everybody, and welcome to PENSCO Presents Alternative Asset Valuation with PENSCO and Frank Bridges. I'm your host, Chris Orr. I'll be walking you through the webinar here until we let Frank take over, so thank you so much for joining us. So a little housekeeping and reminders before we get started. If you're listening to this via the web or telephone, there are some directions up here. There is a dial-in if you prefer not to listen on your computer. We will have copies of all the presentation material available for download from the webinar panel. In addition, all attendees will receive a link to the record version of this webinar via email by early next week, so you'll have a couple ways to access it. Everyone's automatically on mute. We will have a Q&A session at the end of the presentation, and we'll have some directions at that point as well. But to submit a question, please use the question feature on your webinar panel, which should be on the right-hand side of your screen. We will attempt to answer as many questions as possible. We typically get a ton, so we'll consolidate and get through them as best we can when we get there. So just hold on to the end for that, and then we'll get to those questions when we can. Again, I'm Chris Orr. I'm on the PENSCO side of this webinar. Frank will be taking over in just a second, but just a little bit more house cleaning. Information in today's session is for educational purposes only and is not intended as or may not be relied upon as tax, legal, investment, or other advice. PENSCO performs the duties of a custodian and as such does not evaluate, recommend, or endorse any particular investment opportunities. You are advised to consult your professional advisors for specific guidance regarding your investments. Investments are not FDIC insured and are subject to risk, including the loss of principal. So a little background on PENSCO. PENSCO has been in business since 1989, and we are the industry's leading premier self-directed IRA custodian. We have over $12 billion in assets under custody and over 48,000 client accounts and 42,000 unique asset types. We know what it takes to buy, hold, and custody alternative assets and retirement accounts, and we've been doing this for a long time. Some of the administrative services we actually do provide are quarterly statements, annual asset valuation, solicitation and reporting, and required IRS reporting. We do have online account management, and we do have professionals here to guide you through your self-directed IRA experience. So with that being said, I'd like to introduce our special guest today, Mr. Frank Bridges, attorney and managing partner and founder of the Heritage Design Law Firm, LLC. Frank's been working with self-directed IRAs for almost 2 decades, since 2001, and Frank is not affiliated with PENSCO Trust, its parent Open Bank, or any other affiliates. Frank is not being paid for being here, and he's here for educational purposes. So for that, I'm going to hand it off to Frank and let him take it away, and again, we'll get to your questions at the end of the presentation. Thanks so much, and thank you, Frank.
All right, well, thank you very much. I want to tell everybody that I'm certainly very privileged to be giving this talk today. We're going to be talking about how to value assets in your self-directed retirement account. Just to begin, I have to give my own disclaimers, which I'm not going to read entirely. It's just essentially that there's no lawyer-client relationship here. This is all for informational purposes. You can't rely on the information on this webinar to avoid taxes or penalties. Really, this is just for informational purposes, and I think everybody understands that. So our agenda for today is to talk a little bit about a report that came out by the Government Accounting Office in 2016, because it's very relevant to what we're talking about today. Then we're going to go over the calendar that's used for valuation purposes during the year. There are various different milestones in the year that you have to be aware of for valuation. And then we're going to go into the valuation reporting process and how to calculate various different methods of calculation. And I'll have some special notes on Roth conversions. And then we'll talk a little bit about how your asset valuations are reported to IRS. And then finally, there are so many different ways to value different types of property, and we'll talk about how you might choose which options to pick. So let's talk a little bit about the Government Accounting Office report. They apparently came out with a report in 2014, the result of which was that in 2015, the IRS started changing its form so it could gather more information about self-directed retirement accounts. And just as an aside, the term SDRA, I refer to SEDRA as a self-directed retirement account, which could include any kind of self-directed retirement account, including IRAs, Roth IRAs, solo Ks, simple plans, SEP plans, et cetera, et cetera. So I refer to them all as SDRA, or SEDRA for short. The report observed that there are nearly 500,000 self-directed retirement accounts investing in unconventional assets. At least there were in 2015. I'm sure it's grown since then. That SEDRA owners are responsible for account management and compliance, which is an important observation because although your custodian takes care of a lot of things for you, you are still responsible for how things go with your retirement account. And as a result, you face a lot of challenges with tax liability, valuation, and distribution, unrelated business taxable income, for example, and prohibited transactions. And IRS provides very limited guidance to assist you. So the GAO actually said a few things and made some recommendations. And when you read the report, you sort of think that the GAO was criticizing IRS. They also included IRS as a response, which was very polite, saying, well, we're studying the issue. We're probably going to do this in connection with new regulations issued later on, and then, of course, we're probably not going to get too many regulations issued now because of the new administration. But they suggested that IRS target its guidance to IRA owners so that they could help navigate the various different compliance challenges that they face. So there were a couple of very specific recommendations. One was that IRS has to add more information to its publications so that people can understand the potential tax liabilities arising out of unrelated business taxable income, which most people don't want that as a surprise, although sometimes you choose to finance a purchase of a piece of property, and you choose to have a debt finance, for example, so you have unrelated debt financed income, just because the after-tax return is simply fine for you, and that's the appropriate thing. But also the GAO also said that the IRS should provide more guidance on how to value the assets, the hard-to-value assets in these accounts, both for owners and custodians. So, you know, this is all a developing area. It's important to be aware of various different developments, and it's not easy for a self-directed retirement account owner who isn't looking at it every day. Maybe you have a regular job, or maybe you have a part-time job, so you're not looking at it every day, and you can't really keep up with all the developments. But it's important to be kind of proactive. So just as a little bit of a plug for my firm, we do provide a program for PENSCO accounts that require the special advisor, and PENSCO requires special advisors for accounts that invest in family-owned LLCs and other entities. In other words, more than 50% owned by the IRA and or disqualified persons. And we figured out that we had to be proactive by providing an education program for our clients. So we call that the SEDRA Focus Guide and webinars. We also help them with the administration of their account so that they talk to us and we talk to PENSCO. And we have a program called the First Call Program, where our clients who are in the program can call us and ask us questions about the operation of their investment at any time, and we're not on the clock. It's all included as part of the program. And then recently we realized that not everybody has a family-owned entity, but they still need the proactive help. So we have added on the SEDRA Safeguard program, let's call it SEDRA Safeguard Lite, that doesn't include the administrative assistance. So let's talk about the annual valuation calendar. The custodian generally will request, and many of you will get a request for valuation purposes from PENSCO or your custodian in January of the year, and that would be this year, January 2017 would be when you get it. And the valuation date that they're asking for is December 31st, 2016. So your custodian is going to request your valuation, which they probably already have, and you've probably already got it. And then you've got to report the value of your hard-to-value assets to your custodian between January and March. You have to do it by March 31st. In the meantime, the custodian will send you a 1099-R, which basically relates to distributions that occurred in the prior year, and they send that to you by January 31st, and you probably don't get it until early February. The custodian is required to file Form 1099-R to IRS by February 28th if they're doing it by paper, or they can e-file it, and they can do it, if they e-file it, they can do it by March 31st. So the valuation is due to the custodian. The valuation of your account and your assets as of December 31st of last year is due by March 31st of 2016, and the responsible person is you. And if you're investing in an LLC, you've got to get the cooperation of a manager or the officer. Then the valuation that you report is consolidated by the custodian and put on a Form 5498. That is due to IRS by May 31st of the year. Sometimes it goes on extension. If you have a solo K, you have to file a Form 5500 with IRS by July 31st of every year, and that's provided that you have $250,000 in assets. Usually those are prepared by your third-party administrator or TPA. And then, of course, if you have done a Roth conversion for last year, you have the opportunity to recharacterize it by October 15th of this year so that you can go backwards if you want to. So what is the valuation process? Well, it's really 5 different steps. You have to identify the assets, choose your best option for fair market value, and then for each entity and each asset, establish what you think the asset, what the value is, calculate the value of business interests in each entity that's held by the self-directed retirement account, and then report them by March 31st. So let's talk quickly about how to identify hard-to-value assets. Well, Form 5498, and I'm going to, if my computer will play with me, I'm going to show you the form. That's what it looks like right there. This is Form 5498. And if you remember, I told you that IRS began to collect asset information or collect information about hard-to-value assets in retirement accounts. And if you look down here at the bottom in Box 15A and Box 15B, that's where that gets reported. And 15B has a bunch of different codes, and those codes are alphabetical, and I'm going to go through them quickly for you. Of course, there's stock and closely held corporations, and closely held means anything that's not publicly traded or readily traded on an open market. Long or short-term debt obligations, and that's those promissory notes that many retirement accounts own. Ownership interest in a closely held LLC, that's very common. Real estate, parcels of real estate, etc. Ownership interest in closely held partnerships or trusts. And then there's option contracts and other assets that are not readily ascertainable, where the fair market value is not readily ascertainable. And then if you have a combination of 2 or more of those, then you have a different code that you have to put in Box 15B. And that's all prepared, of course, by the custodian. Now, they have to get that information from you, of course, so your next job is to figure out, okay, what is the best option to establish the fair market value of your specific assets? So let's talk about the various different types. I'm not going to go through each one of them, but for entities like closely held stock, obviously if there are financial statements, you might go by book value. That's one way to value stock. It's not typically considered the best way to value market value, but it is one way. You might have it determined by a business appraiser. You might have an arrangement where the shareholder, if you have common shareholders in a closely held corporation, you might have an agreement among the shareholders about how you're going to value when certain events occur, if there's going to be a buyout, et cetera. Or you might have had a recent offer from a third party to say they were willing to buy out your stock. And that sort of tells you what the value of your stock is. So, and then, long-term or short-term debt instruments, a lot of times IRS wants you to value those with the principal balance plus any accrued interest. But if you hire an appraiser, they might have a different opinion of what the value is based on whether it has security or whether it's in default, the creditworthiness of the borrower. So it might be worth less than the actual principal, and sometimes it's worthwhile to get a valuation process. Again, we have roughly the same options for a closely held LLC. And of course, LLCs are very, very common as checkbook LLCs in this field. So that's one we're going to kind of concentrate on in a couple of minutes. Real estate, of course, if you're fairly early on in the process of owning the property, the purchase price that you had over the last year might be a very good indication of its value. But if you're 10 years down the road, maybe you need to get a real estate appraisal, or you might get a real estate broker's opinion of value. Also, there are websites that report market value. I know some custodians actually rely on Realtor.com. Some taxing authorities actually report what they consider to be the market value of a piece of property, but it's important to distinguish between a reported market value and an assessed value. So the taxing authorities can be very confusing. So it's better to rely on the independent websites and real estate appraisers, et cetera. Of course, if your retirement account owns an interest in a trust, then that can be valued. We're not going to go very deeply into that. And of course, there are option contracts that might be purchased, options to purchase a piece of real estate or something like that. There's various different options to value those assets. So the next step is for each entity, and many people end up investing in their self-directed assets through an entity, like an LLC. For each entity, you have to determine what are the values of all of the assets and liabilities with respect inside that entity. So, and then once you've got those assets, you have to calculate the value of the assets of the business interest. So note that there's two levels here. You have to calculate the values of the hard-to-value assets inside the entity, and also the value of the business interest that you hold if your investment is in an LLC or something like that. So there's two levels of valuation for LLC interests. So first you get the net fair market value of the assets held by the LLC, and then there might be a difference between the value of the assets held by the LLC and the value of your business interest in the LLC, and we'll go into that in a second or two. So for a single member LLC, and I know there are many clients who have these as checkbook LLCs, it can be kind of confusing to say, well, how am I supposed to report my value to the custodian? So we came up with a kind of a formula. Usually there's a cash account and there might be a piece of real estate. Sometimes there's a brokerage account that's held by the LLC for temporary holding pattern for assets to be subsequently invested. So you figure out what all the cash is, and that's the checkbook balance and savings balance on your cash. Figure out the value of the other marketable assets. That's not so hard to do. Then you figure out the fair market value of the hard-to-value assets. You take off the liabilities, and that's the fair market value of the LLC assets. And because your retirement account owns 100% of the LLC, the value of the assets held by the LLC are exactly the same as the value of the LLC interests. And I'll tell you why that is when you can see how it happens when you actually have different multiple owners in the LLC. So let's just do an example. Let's say there was a checkbook with a balance of $3,475. The value of the real estate is $547,000. You've made the choice that you're willing to have unrelated debt financed income. So there's a non-recourse mortgage for $200,000. So the net value of the real estate is $347,000. There aren't any other assets. So your subtotal is $350,475,083. Then let's say that there's an outstanding liability to a plumber who did some work on the property. So there's a liability of $2,300, which leaves us with a net value of the assets in the LLC of $348,175. So that's a fairly simple calculation that you should go through if you have an LLC and it's 100% owned by the retirement account. Now, multi-member LLCs are a little bit different because now we have a distinction between the assets held by the LLC and the value of the assets held by your retirement account, or let's say by the owners of the LLC. So the formula goes to, you have to value the market value of the assets, add the hard to value assets, take off the liabilities, and then there is usually some form of discount to value or adjustment to value that's a result of the fact that you don't own the entire entity, and that ends up being the fair market value of the LLC interest. So let's talk a little bit about those discounts to value. So let's say that we had 3 people who decided to invest in a piece of real estate, and in order to hold it easily, they decide to purchase it through an LLC. It's going to be a managed property. None of them is very experienced in management, so they decide to hire a third party that they all know and trust. And they agree to pay that person a management fee, and that's going to be the manager of the LLC, who's in control of all of the business interests and all the business decisions of the LLC. Why do we decide that? Well, because we know each one of us, the 3 members, knows that the other ones don't know as much as the person that's been hired to be the manager, so they want the manager to be in control of those decisions. And then because of that, that means that each one of the members does not have control over the decisions that are made with respect to the property. So most professional appraisers in that circumstance will say that a minority interest, let's say a third interest or 40% interest, is subject to a lack of reduction in its value because the owner of that interest lacks control over the assets of the LLC or of the entity. So by deducting that, we get what's called the freely traded value of a minority interest. In other words, that's the value of the minority interest if you could sell it to a third party on the market. Well, of course, in most circumstances, you can't. So among us 3 owners of this LLC, in our example, we've decided that we don't want anybody to be able to withdraw their assets or to withdraw their cash because we decided that we want to own the property for 10 years. And having somebody withdraw their cash is going to cripple the enterprise. So you might say, well, okay, I won't withdraw the cash, but I'll go ahead and I'll sell it to somebody else if I want my money. Well, we don't really want that to happen either because we chose each other as partners. And for business purposes, we really don't want to have a third party coming in that might be disruptive or that we don't trust, etc. So we're going to also put a restriction on the ownership of those LLC interests that says you can't sell them unless you get permission from the rest of us. And that's what's called a restriction on transfer, and it results in a discount for a lack of marketability. So after you take off that freely traded value for the minority interest and you take off the lack of marketability, you get the fair market value of the minority interest. So let's take an example. So let's say in this multi-member LLC, the minority member owns 40%. And the manager determines that the net fair market value of the LLC assets, that's described above, is $348,415.83. Well, 40% of that is $139,366.33. That is the prorated value of the 40% interest. If it's my 40% interest, that means that if the LLC were liquidated today, that's what I get. However, I don't have control, so it's typical for a professional appraiser who appraises business interests to say that the fact that I don't have control means that it's worth 20% less than it would otherwise be worth. So we're going to take off a 20% discount, leaving the freely traded value of the 40% interest at $111,000. But we also have that lack of marketability, so the appraiser is also going to take a discount off of that value of another 15%. That's $16,000 or $17,000. So the net value of my 40% interest is not worth $139,000 because I can't control and because I can't sell it and I can't cash my interest in to get my cash. It's really for marketable purpose. I'd have to get consent from everybody else. It's really only worth $94,769.53. Well, this is the kind of valuation that's been done for a very long time in the estate and gift tax area, and there are a lot of regulations in the estate and gift tax area of the Internal Revenue Code about how that can be done in intra-family transfers. So transfers between parents and children, etc., those are subject to a lot of restrictions on how you can actually have these discounts, and IRS has been fighting those discounts in the estate and gift tax area for a very long time. But guess what? None of those provisions apply in the income tax area. So let's say that you are going to have a Roth conversion. So you're going to convert the LLC interests from a traditional IRA into Roth, into a Roth account. Well, the income based on the prorated share would have been $139,366.33. But we had the interest that I'm converting, my 40% interest, valued by an appraiser as of the date of the conversion. And he came back and said that the value of the interests that I converted was only $94,769.53. So that means that the difference in income is $44,597. Well, that's not a bad result because it saves me tax if I'm at the 39.6% bracket of $17,000. And you know, you might look at that and say, look at that askance and say, well, that doesn't make sense. It sort of smells, etc. But honestly, if you have an appraiser that tells you that the value of your interest is $94,000, the only measure of value that you have, unless you find somebody else that tells you it's worth something else, is that appraisal. So when you file your income tax returns, report the Roth, you have to give the appraisal to your accountant who puts it on your income tax return. And you file a return, attach that appraisal that says what the value of those units was, and that goes into IRS. You also have to report that value to your custodian because, remember, they are going to report that Roth conversion on Form 1099-R, which comes out at the end of January. So you've got to make sure that the custodian knows what the value of those units was at the time of the conversion, that 94,000 figure, because they're going to report it on a 1099, and you want the 1099 to match your income tax return that you file on April 15th or later if you have an extension. So the effect of owning an interest in an LLC or other entity, corporation or otherwise, of a minority interest can be quite dramatic when, in particular, you're going to do a Roth conversion. It's also important to recognize that if you make distributions, minimum distributions, etc., those minority interests that you hold in other entities may not be worth the prorated value of what you actually put in, or even the principal investment, until you actually realize on your investment 10 years later. And remember, there are good business reasons, as I discussed, why we have all those restrictions in the LLC. We just want to make sure that the enterprise goes along well and it doesn't get disrupted by withdrawals of cash and by transfers of interests. So it's quite normal for a business appraiser to tell you that the value of the interest of minority interest is quite a bit less. So then we have to report the value of the sum of all the assets to the custodian, and that includes business interest, by March 31st. So how does your custodian report the value to IRS? Well, they use Form 5498, and I'm going to switch over if my computer will play with me. This is Form 5498, and this is the form that they use to send in for your account. And again, so notice that there are rollover contributions, there are Roth conversion amounts, and then there's even a box for recharacterization. So the value that you reported to the custodian for what the value of those assets was for Roth conversion would go in there. And they're also going to report the fair market value of the hard-to-value assets way down here in box 15. So that's the form that's used to report account values, contributions, Roth conversions, Roth recharacterizations of particular types to IRS by the custodian. And again, they're supposed to do that by May 31st, but sometimes they put that on extension. So it really is important, though, because you're going to get your own copy of that form, to review the form yourself to make sure that the information on the form when you get it was actually accurate. And the reason for that is, even if you're not making distributions this year, IRS is beginning to realize that if an account, a retirement account, goes along for 10 years at a value of $100,000, and then all of a sudden there's a valuation that comes in that it's worth $500,000, gee, that looks a little funny. So they might start looking into things like that. And so you want to make sure that you're relatively consistent in how you report the value of the assets, and that you correct any errors that you see on the Form 5498 that the custodian reports to IRS, because they can amend those. So how do you choose what your valuation options are? You know, you might have a qualified appraiser do it, but they can be fairly expensive. It's a lot less expensive to have a broker give you an opinion of value. Some accountants actually provide valuation services for entities that they provide the accounting services for. And, you know, we have a negotiated sale price, et cetera. These are various different types of valuation options. So how do you choose which valuation option? Well, it's important to figure out what's at stake when you choose your valuation option. Because, you know, if you're 30 years old and you're not going to retire for another 30 years or 40 years, you're not going to take any distributions, and you're just going to hold an asset for a while, does it make really a lot of sense for you to go out and get an appraisal of the asset, particularly if it's every year, particularly if the asset's worth $50,000. It might cost you several $1,000s to get an appraisal of a business interest or something like that. So, you know, you got to realize what's at stake. At that particular point in your life, it may not be necessary to get an appraisal. There may be a better option for you as a practical matter. So what it really is all about is Form 1099-R and your income tax return. So the key points of valuation is when that 1099-R gets reported to IRS, it's reporting in-kind distributions. So if you did a, let's say you did a 60-day rollover, well, the accountant that, the custodian that you rolled it out of is going to report that as a distribution. It's not until the recipient of the rollover funds gets it that it squares up with IRS on the reporting that it wasn't a distribution. Then, of course, there might be required minimum distributions. There might be in-kind rollovers. And then, of course, you have the biggie. If there's been a prohibited transaction and you have an IRA retirement account with hard-to-value assets in it, it's disqualified as of January 1st of the year in which the prohibited transaction occurred. There's no cure for that. And so it's important to make sure that you are accurately reporting what the income is and what the value of those assets are. You don't want IRS to come along and say, oh, we disagree with what your valuation was on those assets. You owe us more taxes. So sometimes there are removal of excess contributions, there's Roth conversions, etc. So what happens if you overvalue the asset? Well, of course, as you saw in the example of the Roth conversion with a closely held entity, you're going to increase the tax liability that you have for whatever it was that's considered a distribution. That Roth conversion is considered a distribution, even though it's still in a retirement account. It's treated as if you took a distribution, so you get taxed on it. And then, of course, you're going to increase the tax liability for Roth conversions. So you want to make sure that you're not overvaluing your assets. And then, of course, you don't want to undervalue your assets either, because you might find that there's going to be additional taxes if IRS comes along and says, no, that's an undervaluation. And then if it's a number of years down the road, it might be a big surprise to you, so you end up with interest on the unpaid taxes, late payment penalties, and accuracy related penalties. So those are the stakes. So what are the penalties? Let's talk about the accuracy related penalties. The penalty is equal to 20% of the underreported amount due. All right, so, and there are two different types of accuracy related penalties. One of them arises out of a negligence or disregard of the rules, and the other is out of a substantial understatement of the tax liability. So what is negligence? Well, the IRS has regulations that tell us what they consider to be negligence, and that is the failure to make a reasonable attempt to comply with the rules about reporting your taxes. And then, of course, there's an intentional disregard, which they define as a careless, reckless, or intentional disregard of the rules. So how would you avoid those penalties? Well, you would try to be very reasonable in how you reported it, and you pay attention to the rules. Talk to your accountant. Make sure that you're not filing things negligently or disregarding what the actual rules are. You have to know what the rules are. Then there are penalties for substantial understatement. All right, now a substantial understatement of the tax liability is one that is at least $5,000. The tax liability that you reported was at least $5,000, or 10% of the tax that should have been paid was underreported. So if you only reported 80% of what the tax should have been, then you're going to end up with a substantial understatement of the tax liability. So how do we deal with that? Well, how do we get relief from that? Well, if the taxpayer had a substantial authority for the position they took, or if they adequately disclosed the relevant facts affecting the items of treatment and had a reasonable basis for the tax treatment. Well, all right, how do you get there? What would you do to make sure that you didn't get a substantial understatement penalty? Well, typically what happens is that people ask a lawyer if they have anything that is questionable. They might ask a lawyer or an accountant for a tax opinion. And typically those tax opinions, they don't get you out of the taxes that are due, but they can, because you then would have a reasonable basis for the tax treatment. They can actually get you out of the penalties, particularly if you adequately disclosed what the relevant facts were on your tax return. So that is one way to avoid those penalties. So if we're choosing valuation options and we're in a situation where we're really concerned, like we have a true potential tax liability because we have a distribution, or we have minimum distributions, or we have a Roth conversion, or any of those things, typically if it's a closely held stock, we're going to choose to have a qualified business appraiser. In other years, we're going to use our best judgment in figuring out what's the best method for us to figure out the market value. It may not be, as a practical matter, worth our while to hire an appraiser in every situation, it is important for us to be sure that we are reporting things as accurately as we can in terms of the market value. And it's important that we be consistent over time about how we do that, so that we actually do, if the property is growing in value, our account does actually grow in value over time. All right, so long and short-term debt obligations, best way to do that is to have a financial instrument appraiser, and closely held LLCs, et cetera. There's lots of different ways, but typically the best way to do it is to have a qualified appraiser, or if you have an agreed upon buyout value and you might update that every year with your other owners, that might be a way to do it. Qualified real estate appraisers, etc. So, in summary, it's important to be aware of and schedule the key annual dates for valuation events. You don't want to miss those. What happens if you miss the valuation date with your custodian is that they start to get nervous that they're not going to be able to report accurately to IRS, and if that goes on too long, they can resign from custodianship of your account. What happens then is they'll notify you that, and they will give you time to provide the accurate information. But if they withdraw, they can simply, and this is generally under your account agreements, they can simply distribute the assets out to you, and guess what? That ends up being ordinary income that they report to IRS. Be sure to report the value of the hard-to-value assets to the custodian on time. Understand how to calculate the fair market value of single-member and multi-member LLC interests. Understand how to do that for other types of assets as well. And for specific hard-to-value assets, choose the most reasonable valuation option based on the practical tax reporting needs that you have. If you're 20 years away from taking any distributions, and you have a piece of real estate, I would get an opinion of value from a real estate broker. I don't think I would go out and get an appraisal. But if I have to distribute out a portion of a building that I own as a minimum distribution, well, I'm going to have to go get a fair market value appraisal from an appraiser. So, thank you very much. And Chris, I'm ready to hand back control.
Super, Frank. Thank you. That was great information and very detailed. We appreciate the info there. We did get a couple questions here, and I'm going to put the question screen up here in just a second. And I just grabbed control from you there, Frank, so don't worry about it. So for those of you listening, if you do have a question, we've already got a couple here, but if you do have an additional question, this is the way to insert them to us. I'll leave the screen up for just a couple minutes here before going to the next one. And so, Frank, I'm gonna rattle off a couple of the first questions that we got here. And we got this one a couple times. So what's the most common issue you're actually getting from your clients who are using your services to do these valuations? Is there one big pitfall that people run into a lot, or something that's fairly common in the area?
Well, honestly, the most common question I get is, how do I actually add all this up and report it? Most people understand how to figure out the value of a piece of real estate that's held by an LLC or something like that. But the idea of how to report the value of their LLC interest, which is held by their retirement account, the retirement account typically doesn't hold the underlying property, it just holds the LLC interest. Getting their heads around actually how to put all that together is actually the most common question that we have, which is why I put together that formulation for how to actually value those assets for our clients.
Great, thank you. And speaking of those single member or family controlled or checkbook, as some people like to call them, LLCs, when someone is putting together that equation, who actually determines that calculated value? Does the IRS require a third party? Is it the LLC manager? Who can actually be responsible for doing that calculation?
Well, that would typically be the LLC manager who puts the calculation together based on accurate information that they have. So the manager might go out and get an appraiser to appraise a piece of real estate. They have to balance their checkbook at the end of the year, so they know what the checkbook balance is, they know what their liabilities are, they know what they owe to various different people, so they have to basically put together a balance sheet at the end of the year. A lot of times if we have a single member LLC, that's going to be the IRA owner. If it's a multi-member LLC, it's going to be the manager of the LLC that puts all that information together, because they're the ones who usually have the information. They will then hand it out to the other members. Many times they'll file a return for the LLC if it's not a single member LLC, and the member will receive a K-1. Well, that's the report that the entity gives to its shareholders or unit holders. The K-1, of course, doesn't necessarily go to the custodian. That's just the amount of income. So that really doesn't tell you what the value of the assets were at the end of the year. You have to go back to the manager, if it's not you, and say, you know, I really need to have a balance sheet showing the real value of the assets as of December 31st, and that's the market value of the assets. So it's usually a combination of the IRA owner, the manager, and third parties that they hire to give an opinion of what the value is.
Okay, great, thanks. We got time for a couple more here and some specific ones. So here's a question that just came in. Can you value a promissory note as the amount someone would buy it for, which would include the payer's payment history and things like that?
Yes.
Excellent. That's a good answer.
but I would not do that on my own. I would typically the easiest way to report the value of a promissory note is simply put in the value of the accrued interest and the principal, and then you don't really have to worry about IRS arguing you about it. However, if you're going to take a distribution of a portion of the promissory note, or if you're going to convert it to Roth, for example, you would want to get a third party to tell you what the actual value was. And you wouldn't want to do that yourself, because IRS is going to look at the return and they're going to see that there was not a third-party person who valued it. So that could end up, and these kinds of things are developing. IRS is gathering a lot of information about these returns and learning how to look at them. You know, they're going to say, well, that might be an audit point. If they see a Roth conversion without an appraisal of the value of the assets converted in a hard-to-value situation, they're going to pick it up and they're going to call you up and say, hey, what's the basis of your valuation? So it's important to have the basis of a valuation that you feel comfortable with reporting on your income tax return, because you don't want those penalties.
Absolutely. Definitely want to avoid those audit questions coming in. So we got time for one more here, and for all those that we didn't get to, or if they come in after the fact, we will definitely get you answers afterwards. But this one's pretty specific, and I want to give Frank some time to work through this. So the question is about a percentage-ship owner in an LLC that's resulting in UBIT. The owner of the LLC is 59.5 and is curious as to what the best course of action would be because of the UBIT. Would it be to distribute and pay the tax, or get a different appraisal? And at what point would you think you would distribute that asset? I know that's a multi-pronged and kind of interesting question there, and we didn't really get too much into UBIT. But essentially, at the age of 59.5, with a LLC interest that has good cash flow but is generating UBIT, is it better to distribute or better to keep that in the account?
Well, I would say the answer to that is what's the after-tax return? You have to take a look at what the bracket would be for an IRA. Let's say it's an IRA and they're going to report UBIT. A lot of people panic when they discover that they've got UBIT to report for their IRA. But all right, so you go through the reporting process. You file your Form 990T you prepare it and you give it to the custodian who has to sign it and send it in and pay the tax. Well, after that tax, what is the return on the investment that was done by the IRA? I typically say if the return is 15% or more, even after your retirement account's paying the tax and there's cash flow to pay it, well, that's not a bad investment anyway. On the other hand, let's say that there is your personal bracket is lower than the bracket of the IRA, which, by the way, gets to the highest bracket very quickly, much quicker than an individual. If your tax bracket is lower and you can report the income on the distribution, that would be fine. But typically, I would say try to keep it inside the IRA. Determine what you think the after-tax value, after-tax return on that is, and then you can make a logical choice about whether you should have it distributed to yourself or whether you should leave it in the IRA. Because, you know, as long as you leave it in the IRA, that value continues to grow without tax. But as soon as you take it out, all that extra cash flow, you get to pay whatever the tax is going to be on it, as well as the tax on any growth you have in investments that you acquire with it. So if you have the opportunity to leave it in the IRA and the cash flow is good, in the question, the cash flow was very good, so that suggests that the IRA is going to have the money to pay the unrelated business income tax, so maybe that's the best course. A lot of times, though, let's say that the entity isn't designed to have an investment by a self-directed retirement account, which sometimes happens, and they're not really reporting the values to you. They're sending you a K-1 that suggests that you have unrelated business taxable income. Your IRA doesn't have any cash in it to pay the tax on it, so you have to make a contribution to your IRA or roll money over from another IRA to pay the tax. That's not necessarily a good situation. So you might want to either distribute that, or if you can, liquidate the investment and find something else.
Great. Thank you so much for that. That was a very specific question, so we appreciate it. We got time for maybe one, maybe two more here. Here's a question. How do you value a non-performing loan so that you don't have to pay tax on it?
Let's assume that we're distributing a non-performing loan.
Correct.
Does that make sense? Okay. Well, a non-performing loan is one that if it hasn't been paid and it's in default and it's uncollectible, well, then I would want to maintain that that's worth zero. All right, because you're not going to get the money. On the other hand, if it's collectible, if there are payments but there's difficulties, then it isn't worth zero. It's somewhere between 0 and 100% of the principal. So anywhere in there, you're probably going to want to get a third party to tell you what the actual value of that promissory note is, because there are a lot of different factors that you have to think about. What do other promissory notes? What's the value of other promissory notes that are in default or have borrowers who are not necessarily credit worthy? How does the market value those? There's probably not a lot of information about that except for appraisers, and appraisers do have that kind of information. So depending on the size of the promissory note, you know, if it's a $10,000 promissory note, it might not be worth hiring an appraiser. But if it's a $500,000 promissory note, and you're going to have to distribute it, and you think it's worth zero, and IRS, if they look at it, is going to want to say it's worth $500,000. Well, then it's really worth it to get somebody who can give you an independent appraisal of.
Very helpful. And then I'll piggyback on that just a little bit from the PENSCO perspective. Obviously, there are different kinds of notes, and any of them that can become non-performing if that's the way the cards fall. But for unsecured notes, if it's expired, it's past its maturity, it's non-performing, and the borrower has claimed bankruptcy or is in prison or something along those lines, and we'll go through our own devaluation process with the client to get that devalued so it's at $1 or something along those lines so it can be distributed without having that tax hit. But it is obviously a case-by-case basis, and so having that third-party administrator or whoever it may be obviously could be very helpful. But depending on the structure of the note and the circumstance of the borrower, will help PENSCO determine if we can alleviate that tax burden a little bit for the client.
Right, and it's also important to remember the consistency issue. If you reported it last year at $500,000 and then all of a sudden it's worth $1, and you're reporting the $1 on your income tax return, IRS is going to say, hey, wait a minute, tell us what happened here.
Sure. Well, for everyone else that still had questions, we will make sure to get you some answers after the fact here. We appreciate everyone joining us today, and we hope that you found this information helpful. Once again, there will be copies of the deck and a recording for this out shortly. We do have everyone's email addresses. We'll be sure to get it that way. And for any questions we did miss, we will also get those answers to you that way as well. We'd like to thank Frank for joining us and taking some time to be here with PENSCO in this webinar. We'd like to say thanks on behalf of PENSCO as well. Everyone enjoy your day, and hopefully you got some good information about valuing your assets. Thank you so much, and have a good one.